Did you know that 66% of working millennials have nothing saved for retirement in the United States? Millennials are people or young people in the ages of 29 to around 44. Roughly 30s, people in their 30s, born from 1982 to around 1996. So they're called millennials. So these millennials in the United States, 66% of them that are working do not have nothing saved for retirement. Ladies and gentlemen, retirement, many people after retirement don't take more than 10 years. They become frustrated, they become lonely, and everybody avoids them. I want us to avoid that in the near future. Stick with me as I share with you 5 of the best ways or the strategies to save for your retirement. Thank you so much. My name is CPA Richard JobiesE, finance expert. I am here to share with you. Every day we share a video. We make sure that you understand something in terms of finance. We want to make finance literacy accessible, very easy, and very easy to understand. Easy to access, easy to understand, easy to comprehend, and easy to share. CPA Richard JobiesE. If you are new, kindly subscribe. If you are returning, thank you so much. You're part of our tribe. We love you so much. So let's go to point number 1. It's very important. Get an employer that sponsors the retirement plans. Like, in other words, you know, when you're having a retirement plan and when you're having the pension schemes, most of the times you give 1,000 and then the employer also gives 1,000. So look for employers who are able to finance or to sponsor the retirement plans, such that they can actually do it. Because one thing about it is the retirement plans are tax-free, such that the employer is not charged. It is actually a deductible expense to the employer. So most of them will do it. So even if you're in employment, if you're even in your employment setup and the employer is not doing, talk to the employer. Just tell the employer, I think it is important, put that money aside for me. And then something else you need to understand is that money actually accrues interest. Yeah, it should get something on top. So for 10 years, there's something on top which helps you beat the inflation rate. So that's point 1. Number 2, you can decide to open an individual retirement account or a pension account. Just wake up in the morning. There's so many companies that are having pension schemes. Just go and open an account and be depositing some money there. Deposit some money there. So once you deposit money there, you are able to get something after retirement. You're able to deduct a few pension every month after retirement period. So once you retire at 60 or at 50 or at 65, you're able to get something. And even if something happens and you pass on, that money will be given to your next of kin. Let me share with us a joke. You know, in a company, there's the CFO and then there's the CEO. Most CFOs are people finance, people like us. And then the CEOs are, it depends. Most of them have not done finance, others have done finance, others have just done business. But the CEO his main objective is the company to grow. The CFO, on the other hand, as much as he wants the company to grow, he wants to minimize costs. He wants to make sure he's minimizing costs, and then he's doing what? And then he's maximizing the what? The income. You understand? Minimize costs or minimize expenses, maximize the income. So there's this joke that was shared between a CEO and a CFO. So the CEO comes and tells the CFO, we want to train our employees so they become the best in whatever they're doing. We want to take them back to school. And then the CFO asks, what if they go away? What if they run away? I don't know if you understand. What if they run away? And the CEO asks, what if they don't go away and we've not trained them? So you understand? So sometimes it's very important that you get a CEO that understands that his main intention is for you people to grow and for things to work out. Let's go to point 3. Point 3 is you can decide to automate the savings. Just go to your bank, tell them fill a check of system such that when money comes in, a certain percentage or a certain amount goes straight into your accounts or into the savings account that you've saved for what? For your retirement. So that will help you, because there are times when money comes in and people are still struggling with how to budget. People are still struggling how to manage their money. So many people are still struggling with impulse buying, and just because this is what we call black tax, and I think we'll talk about in the next session. There's a lot of black tax happening. There are funerals here and there. There are people at home we need to support. There are relatives, their friends. There's so much money that just gets out, and there's no receipt and there's no accounts for that. And people don't care. Remember, borrowers don't have limits. We say takers, givers, we say givers have limits, but takers don't. That's what it said. Takers don't have limits. So sometimes when you give, I think it is important to understand your limit. So make sure you've automated what? Your savings. Number 4, educate yourself on investment options. Once you've put your money, let's say for example you have like 100,000 or 1 million. If you are risk averse, take your money and put it in MMF. If it gives you like 10% per year, that is better than that money just lying idle in the bank. Or you can decide to put it in some circles. Some circles also give dividends at the end of the year, dividends against cash or dividends against shares. Shares, of course, is good, but again, you have to be very careful with how the company or the circle operates. Because if again it starts going under, or if scandals start hitting the company or the organization or the institution, then you might lose your money. But that is very important. Educate yourself on investment options. Then what is very important is the 5th bit is start small and increase your contributions over time. Sometimes, as much as people want you to start small, I always believe start big and then continue as you go slow, as you go low. Because when you're starting employment, your obligations are still very less. You still don't have a big family, you have a very small family. You still don't have so much in terms of financial obligations. So always advise, why don't you start giving big? And then as you progress, you can go slow. And then again, when your kids are out of the house, you can continue doing what? Doing it bigger. Thank you so much, ladies and gentlemen. So we've shared 1, get an employer who can sponsor your plan. 2, open an individual retirement account. 3, automate the savings. 4, educate yourself on investment options available. 5, start small or start big and increase your contributions over time. Thank you so much. God bless you. We love you. Thank you.